I hope everyone can hear me. First of all, I want to thank the European Trade Union Confederation for inviting me to speak on behalf of Amundi on this very important topic. And perhaps just to kick us off, I want to share some things about Amundi for those of you who are not familiar, and that'll give you a taste of where we're coming from and our point of view. So Amundi is the largest European asset manager, and in fact, it's the only European asset manager in the top 10 worldwide. All the others are based in the US. And we invest in all kinds of assets, so listed equity, listed bonds, private equity, private debt, real assets, and across geographies. We have approximately 1.6 trillion euros of assets under management. And I think it's important to note that the investment objectives, the investment constraints, the types of clients on whose behalf the money is managed, and the types of companies and activities that we finance will vary widely. We have clients on both the retail side, so end savers, and on the institutional side, so insurance companies, sovereign wealth funds. So we work with Guillaume notably on sovereign wealth funds, and again from various geographies. And on some of these issues, that's a key point. So for instance, if you take climate change and you compare, say, Swedish investors versus US investors, their approach to climate change will be very different. So European investors will be very likely to ask for these climate solutions and even add on a social layer to those, whereas US-based investors are a little bit, I would say, further behind on these issues. As an asset manager, there are basically three main ways that we can invest sustainably. There's exclusions, so on a norms-based basis, for instance, so saying we don't invest in a certain type of activity or in certain types of companies. There's thematic investing, where we focus on a specific theme, so it can be population aging, or it could be specific asset classes such as green bonds or social bonds. And then there's what we call rating-based integration, so we rate issuers, so companies or sovereigns, based on different ESG criteria, so environmental, social, and governance pillar. And then you use these ratings to play around with your investment strategy. At Amundi, and I think it's important to make this clear, ESG is one of our founding pillars. So back in 2006, we signed the Principles for Responsible Investing. We've pioneered with MSCI low carbon indices. More recently, for instance, with the World Bank, we launched the largest green bond fund dedicated to emerging markets. Today, we have approximately 330 billion euros in responsible AUM. And we use all the approaches that I was mentioning, so exclusion, thematic investing, and rating based. But I do want to stress that we have our own ESG rating tool. So we rate more than 8,000 issuers, including sovereigns, according to 37 different criteria. And we use quantitative inputs from data providers. And we have also ESG analysts that provide their insights. And when ESG was cited as a founding pillar of Amundi, many people said that we would be losing money, we would be destroying value, but for us, really, ESG is not only a value that we have, it's also part of our fiduciary duty. And so we've shown recently that ESG has become material and that it actually drives financial performance. So I'm going to stop there on Amundi, and the three main points that I want to make today. The first one is that prior to the COVID crisis, there had already been growing investor mobilization on the issues at hand, so green and social. And that was having a significant influence on the valuation of financial assets, both in equity and in debt markets. So that's good news. The second point that I want to make is that there are still significant obstacles that we see to green and social investing. But we do believe at Amundi that with the COVID crisis, some of these obstacles could be addressed if we're able to embark on a sustainable recovery. And the third point that I want to make is just to show some of the things that Amundi is doing to address these obstacles. So back to my first point on the rise of sustainable investing. So this is a recent trend that was really accelerated by the COVID crisis. So we have a research department that has come out with a lot of papers studying ESG investing and its relationship to financial performance. And we showed that there was a clear break in 2014, meaning that before that period, it was hard to say that there was a significant, consistent impact of the integration of ESG and the link with financial performance. But from 2014 onwards, ESG does become a source of outperformance. And this is both in Europe and in North America, and both in equity and in bond markets. And since 2018 and prior to the COVID crisis, we have also seen some interesting developments. The first one is, and I don't think this will surprise many people, there's a growing gap between Europe and the US. So ESG investing, sustainable investing, has clearly picked up steam in Europe, but in the US it has tapered down. And one of the reasons that we can think of why there's this gap is that sustainable investing, it's on the one hand, investors that are affecting the supply and demand of securities, and so influencing the valuation of these assets. But the role of public policymakers is key. So for instance, when the US withdrew from the Paris Climate Agreement, that potentially might have influenced the regional asset pricing on the environmental pillar. So that's the first thing, a growing gap between the US and Europe. The second thing that we had seen prior to COVID was that the social theme, so the second pillar of ESG, was actually picking up traction. It was catching up. At the beginning, investors were more looking at, I would say, environmental criteria and governance criteria, and were less focused on social criteria. But clearly, since 2018, social is the winning pillar, so to speak. And that's probably because there have been a lot of social narratives that sustainable investors are picking up on. And the third thing that we had seen since 2018 was that this sustainable investing landscape is growing in complexity. And by that, I mean that, so again, if you take your ESG ratings, so Amundi, for instance, will rate issuers on their ESG criteria. Up until very recently, investors were saying, well, I'm only going to invest in the best rated ESG companies, and I'm going to exclude the worst rated ESG companies. And now there are more and more investors that are saying, well, perhaps what I want to do is, okay, I want to invest in the ESG winners, the good performers, but maybe I also want to target those that have less good ESG policies right now, engage with them and push them towards improving their ESG profile in the hope that that will, down the road, derive some financial outperformance. So now we've been hit with the COVID crisis, and the good news is for ESG investing, for sustainable investing, is that in fact, during the coronavirus crisis, ESG funds have been very robust. So first, they performed very well. If we look at March, the MSCI World Index dropped by around 15%, but 60%, so almost 2/3 of large cap ESG funds outperformed the index. And in the US, 40% of ESG funds were ranked in the first quartile of their category. So ESG funds have been performing very well during COVID. And the second point that we've seen is that they've been extremely resistant, meaning that they continue to see inflows. So investors are not running away from ESG funds. And there are possible reasons for this. The first one is that investors may view ESG funds as quote unquote pandemic proof, meaning that since ESG funds are usually overweight sectors such as healthcare and tech and underweight sectors such as energy, and during the crisis, the sectors that ESG funds are focused on have performed very well. The second possible explanation is that ESG investors have a more long-term perspective and are more loyal to these ESG companies. There was actually a recent research piece that showed that 10 years ago, investors on the New York Stock Exchange held stocks for, I think it was an average of 7 years. Today, that number has dropped down to 1 year, meaning that investors are much more volatile in their holdings of stocks, but that perhaps is not the case with ESG investors, which invest in the long term. And the third possible explanation is that perhaps ESG funds are now perceived as the new safe havens, meaning that in the COVID crisis, clearly environmental and social implications were very important. And so focusing on countries, focusing on companies which have strong ESG performance could have been considered as a defensive characteristic. The second thing that's perhaps a little bit less intuitive that we saw during the COVID crisis was that in fact in the US, social investing outperformed, meaning that investors in the US or investors investing in US companies were looking at the social lens, and perhaps even more than European investors. And the explanation for this counterintuitive finding is perhaps that in the US, investors have to take matters into their own hands, whereas in Europe, we have more government policies to support employment conditions and so on and so forth. So really in the US, perhaps investors need to make sure that the corporates themselves are really taking into account social criteria. So, I mean, for me, I work in sustainable investing at Amundi. All these things are very good news. Sadly, there's a long way to go to making sure that that social, green, and inclusive finance reach the ambitious goals that we have. Um, in a very stylized manner, there are three stages, I would say, to the inclusion of a new theme by investors. The first one is consensus, second one, methodology, and the third one is implementation and data. So the first one, consensus, there needs to be a broad consensus on the issues at hand at the academic, at the scientific, at the public policy level. From this consensus, you can get investment frameworks. Investors are able to derive methodologies and then make investments based on those methodologies. But for those methodologies, for those investment strategies to be workable, you need to have the right implementation, and more often than not, you need to have the right data. So again, and I'm speaking in a very stylized manner, most of the issues, so climate change on the one hand, social inclusiveness on the other, are not fully mature. The environment side is probably the most advanced. So on the consensus issue, well, of course, some perhaps on the other side of the Atlantic will say that there is no scientific consensus, but broadly speaking, I think we can all agree on the impacts of climate change. The Paris Agreement was huge in that it set clear goals for the planet to achieve in terms of temperature alignment. And then investors were able to derive methodologies from that, and in large part thanks to the work carried out by the technical expert group, which kind of mapped out the Paris Agreement in terms that investors could understand, so in terms of financial risks. So when we think of climate change, we can think of physical risks on the one hand, transition risks on the other. So investors do have a roadmap. And although data is often and sometimes lacking in quality, it is definitely getting better. So as you all know, the Paris Agreement, to take one example, says that we should aim for a 2-degree world and hopefully a 1.5-degree world. Well, now there are data providers that are able to tell you whether or not your portfolio is aligned on a 2-degree world, a 1.5-degree world, or whether it's more on a trajectory of a 4, 5, 6-degree world. So those methodologies are far from being perfect, but at least we have something to work on. On the social issues, however, I would say we're barely at stage one, so consensus. So if we take inequality, which has just come up a lot in the conferences today and yesterday, well, there's still vast disparities between what is either considered fair on the one hand, or even economically desirable on the other, between, say, continental Europe and the US. I think it's fair to say that we may have different views on the issue. So from an investor point of view, it's hard to get at methodologies, at investment frameworks. We're lacking clarity on the criteria that we should look at on inequality, on the thresholds that we should set. And then further down the road, then we would need to have the right implementation, we would need to have the right data. So on the social aspect, I would argue that there's a long way to go. But we do believe that the recent COVID episode has the potential to change this. So in the environmental sphere, and I won't go into details because many people are better placed than I am to speak about these things, but we have seen momentum for a green recovery, both on the public policy side, also on the corporate side. This green recovery will require massive financing, as Marco was saying, so public money for sure, private investors definitely, and we think that some financial innovations are probably necessary to accompany such a large-scale program. For instance, I can think of one example, which is green securitization in Europe, which is not developed enough, but we have seen some very positive signals from the European Commission and from European financial institutions on the need to develop this kind of innovation. And in the social sphere, where again, I think it's fair to say that we lack some sort of consensus, the huge pressure on social systems that we've been discussing, the calls for a new social contract, may make this consensus issue moot in a way that, since inequality is increasing everywhere and the need for inclusiveness is increasing everywhere, perhaps we will all agree that we actually need to tackle these issues. And at Amundi, we've been doing some work on launching methodologies that are, for instance, able to look at inequality and also on the just transition. So the just transition for us, this is work that's mainly been carried out by David Wood at Harvard and Nick Robbins at the LSE, and which stems from a lot of the things that have been done, in fact, by trade unions. The just transition being ensuring that the transition to a low carbon economy is done in a way that's fair and inclusive for all. Well, we've been working on methodologies to include those two. So maybe if I say one word on the inequality methodology, we've recently launched the first fund that seeks to incorporate inequality in its investment framework. And basically what we do is we assess companies based on whether or not they're participating in the relative reduction of inequalities in their home countries. So the way we do it is that we rate countries on inequality along 5 pillars: fiscal policies, labor policies, diversity, health and education, and human rights. And then we'll rate companies in a similar fashion, and we'll exclude companies that are performing very poorly on the aggregate level, that are performing very poorly on those 5 pillars, and then that are performing worse than their country of origin. So say if you're a Swedish company, like IKEA, given the fact that Sweden is a relatively good country, so to speak, in terms of equality, then you better have even stronger policies than the status quo in Sweden. And as I was saying, we're also working on methodologies to incorporate the just transition. But again, it's a real challenge. I mean, how do you make sure that you have the right data? Are you looking at the right KPIs? The just transition poses challenges that differ widely from country to country. So for instance, and even countries that could seem very similar, so even from France to Germany, the social issues from the transition to a low carbon economy will differ widely. In Germany, you have a huge automobile sector, which is less the case in France. So you have to look at sector by sector, country by country. So these things are, at Amundi, we're working hard to making sure that we have something that's consistent and that's applicable to a more global investment stage. And last but not least, I think one of the key things for the private sector and for investors in particular is the engagement aspect. Because at the end of the day, in listed markets, when you're looking at these huge companies, you won't only find pure players, you're not going to find only perfect companies on each and every one of those aspects. So you'll find companies that are transitioning, that are trying to improve their sustainable policies, and sometimes that are struggling to do so. So the approach cannot only be negative, it cannot only be about selection and inclusion, it also needs to be about engaging with them and using the power that the private sector has, that private investors have, to make sure that these companies embark on more sustainable paths. So just to wrap up, I would say, especially on social issues, that we need to work on consensus, meaning we also need clarity from policymakers, which is why these types of discussions are very important, including to have academics. We need methodologies, and then we need data.
How attractive are ESG investments for businesses?
Building on what Théophile has just presented, I'd like to put the focus on the social dimension of investments. And so first to perhaps frame what we are talking about, to recall that we are talking about all the industries and sectors, not only the sector having a social and solidarity purpose, for instance, association, cooperatives, etc. So we're really talking about what's the social component, and also, I mean, the environment component of activities such as car making, agriculture, or chemistry. So it's really these dimensions across all sectors. So why is that there is the perception that the social dimension has been lagging behind? First, I think that the social dimension is less visible and tangible than the environmental impact. Although there are really tangible things to measure social unrest, inequalities, but when you think about carbon emissions, CO2 emissions, carbon pricing, it's much easier for an investor, for instance, to then go down to measure the performance of the environmental dimension. And also, for some, there is a sense of urgency linked to climate change that is quite visible. For instance, the biodiversity impact, the wildfires. So it's touching many different categories of people all across the world. Whereas the social dimension sometimes is a bit hidden. So I think this is our role to make it forward and to bring it to the front. And also, from the point of view of an investor, and Théophile has already mentioned that, there is the issue of the materiality. The materiality is the kind of information that affects the judgment of an investor. So they collect information coming from companies. When they can get this information, when there is a transparent reporting, then they make a judgment, and then this judgment inform their investment decision. So what we need to do, I think, and this is the whole concept of the just transition, is to incorporate the social performance, so as to say that when a company performs well, what's the participation of the social component, and then what we can do to improve that social component. So there are many ways to do that, actually. So when it comes to the just transition concept and bringing back the social component, there are ways for the policymakers to put forward these tangible indicators. So we have, for instance, indicators where we all know, like the health and safety indicators, the gender pay gap, the rate of job creation and job destructions in certain sectors, the budget spent on training, on retraining, the age mapping, the engagement rate. So these are all metrics and data that HR departments are working on. So these can also be used by the analysts to measure the social performance of companies. And this is what I think we should aim to do. And so at European level, the European Commission has put forward the European taxonomy, for instance. This is with a focus on the environmental part, but that could be like a new initiative to then create a European social taxonomy with certain kind of social proofing that would be built around some common indicators. And Théophile has also mentioned that the need to build some common grounds around this social indicator. Then I will perhaps recommend to be very concrete, and also as social partners, and what's the social partnership and what can the social dialogue can achieve at company level. There is one way and one mechanism that has been quite efficient is to pair or to link the compensation of executives and managers with social and environmental performance indicators. So you would compensate not only on the basis of economic indicators, but also on some social and environmental indicators that are reached. And this has proven to be quite efficient to improve the CSR performance of companies. However, some research papers, actually by economist Patricia Criffo, has shown that this works if the company is working towards its stakeholders, not only shareholders, but stakeholders. And I think this is an important concept to follow up on and to push forward. But it takes time to put forward the social dimension. It takes, of course, more research to analyze this materiality, to analyze this the real performance. But also it takes staff training and management training to make CSR at the center of the strategy and of a long-term strategies in companies, rather than being a separate process. And that's the challenge I think that we all have to on this just transition, is to make the social component along with the environmental component as central to the strategy of companies. So I think that I will stop here for my first reaction, and perhaps we can pass the other discussant.
What is the role of social rating to promote sustainable investments?
Much, even for hosting me today, and to all the panelists and the organizers of this amazing event. So I'm here today to represent Standard Ethics. My name is Manfredi. I'm the solicited rating team coordinator. So let's say that I coordinate the analysts that analyze companies on a solicited basis. And yeah, so today I will present what is Standard Ethics and what is sustainability for us and how it can be measured. So Standard Ethics is a London-based, self-regulated sustainability rating agency that issues no financial ratings. Its clients are companies that have applied to Standard Ethics for a rating. Such request establishes a confidential relationship between the parties, so the agency cannot and does not use data collected outside the agreement with the client, and does not engage in asset management activities or advise third parties. So our point of view is a bit different from Guillaume and Théophile point of view, since we are not asset managers, we are a sustainability rating agency. So we follow on a voluntary basis the European Securities and Markets Authority guidelines, and the disclosure of any rating action is regulated by procedures. So we have a compliance officer and we follow the Chinese walls between different functions to preserve our independency from investors and even at an internal level. So the notion of sustainability adopted by Standard Ethics is the one proposed to the United Nations in 1987 with the Bronten report called Our Common Future. So it is a development that satisfies the needs of the present without compromising the capacity of future generations to satisfy their own. Sustainability, we believe, is a planetary theme, is a global concept to tackle the great climatic, social, and economic phenomena, which go beyond the borders of a nation and the perimeter of a single company. So the work of Standard Ethics analysts is to provide the client with a detailed picture of its positioning with respect to the sustainability and corporate governance guidelines proposed by the international organizations, so the United Nations, the OECD, and the European Union. The agency also issues unsolicited ratings where it intends to offer stakeholders indices benchmarks, which are published online and public. So, the business model of Standard Ethics is based on the applicant pay model. It offers solicited sustainability ratings and delivers them with maximum independence from investors, regulators, consultants, and certifiers. The rating is a rating of compliance of companies and sovereign nations on matters such as governance and sustainability, as indicated by the guidelines of international organizations that I mentioned before, so the United Nations, the OECD, and the European Union. There are 9 different classes of rating. The letter is from Tripoli to an F, but E stands for Europe. And the rating can be divided into 3, let's say, levels. So a full investment grade, a lower investment grade, and a non-investment grade. Standard Ethics methodology is based on a 6-group variable proprietary algorithm, and the agency doesn't use weights or KPIs to make its analysis, to issue the ratings. So the algorithm, I would like to summarize it, can be divided into 3 macro areas of analysis. One is the company's positioning in the market. The second area is the so-called economic democracy rate of the company. So basically it's corporate governance and how shareholders are treated. And the final area is the pure ESG area. So the governance of sustainability and the company's ESG voluntary policies and rules. Some key aspects of the Standard Ethics rating is that the agency uses an analyst-driven rating process, which differs a little bit from the questionnaire-driven process used by consultants who have to update and expand their databases. So with this process, with the analyst-driven process, the work to be carried out doesn't require applicants to fill out forms. Standard Ethics analysts are those who will gather the required data, and the information kept during the assessment is only kept for a limited period of time, and it's not used to enrich databases. So we do not carry out consultation or research on behalf of third parties, and we cannot use data collected for purposes other than the rating. With the issue of the rating, the company client or the applicant receives both the analysis document, which it's kept confidential between the parties, so the so-called standard ethics guidelines, and the final report of around 15 pages that can be used to be published at the external level if the company wants to do that. So there is not a precise answer on why to get a corporate rating from standard ethics. There are many. So the classic answer we give normally is that we don't know. It's entirely up to companies who can do that on a voluntary basis. So some corporate objectives, of course, can be attained thanks to the standard ethics rating and relate to the company strategy, governance, relations with stakeholders, further communication matters with the finance world, the credit sector, or simply can be seen as a process of internal cultural innovation on sustainability within the company. As a sustainability index provider, when it enters to a new market, the agency analyzes the major listed companies and issues them an unsolicited rating, which, as I said before, can be used as a national index, a thematic index, or a regional index as a benchmark, even by institutional investors. To date, the agency covers the major industrialized markets worldwide. So in May 2020, the agency has published online on its website an ESG methodology overview, which is a sort of proposal on sustainability ratings and their issuance, even in a post-COVID world. So there are three main points that I would like to stress from that paper. So if you want someone who correctly measures sustainability as defined globally by organizations such as the European Union, the United Nations, or the OECD within their ESG policies, we have to find him outside investors. And first of all, it must not be paid by investors or work on their behalf. So the business model should be the applicant pay model. Secondly, it must adopt a scientific yardstick using possibly one holistic methodology. And finally, it must be independent, so it must not be involved in other activities or issue credit ratings. And on a proposal on what sustainability might be in a post-COVID world, we are, and we know that, at historical moments when there is the need to develop a strategy aimed at the reconstruction of the economy. So in that very specific moment we are facing, voluntary non-financial activities based on being responsible or being ethical will not find the common guidelines that seem advisable. There are at least three advantages of sustainability. The former is uniformity of action. The second is the possibility to limit the cases of greenwashing. And the final one is comparability. So, and I conclude with this, in order to guarantee a future for the next generations, sustainability must be or should be correctly identified, circumscribed, and shared.
What will the pandemic mean for sustainable investments?
So I'm hearing some worries that after COVID is done, we'll return to a status quo, and indeed that's a real risk. There's a risk that investors everywhere will say, well, now that this is done, we don't need to care about social anymore. That's the way it is. It's a risk. At Amundi, what we're arguing and what we've been arguing for a long time now, and this is what I tried to convey in my introductory remarks, is that we believe that integrating the social lens, integrating the things that Guillaume and Manfredi have also talked about, it makes sense for investors. It makes sense for them. It's financially material. And these are some of the conversations that we need to have. So to give you an example, just so that you can see what we have to work with. If you go to some regions and you say, we have a great new social product, let's take the inequality product, for instance, are you interested? They'll say, what's the impact on the return? That's the first question that they'll have. And we need to be very clear about that. And so when we think about these social things, and that's why I was talking about consensus, and I'm going to echo Guillaume in the fact that we need to showcase the importance of these criteria, because that's what investors are looking for. On the trade unions, maybe one word on that. We definitely recognize that trade unions, well, they play a huge role, and even more so with the COVID crisis. And I think there are lots of papers that have come out that show that the rate of unionization can be linked to better social policies and so on and so forth. In fact, in the inequality fund that I was mentioning, or the equality fund that I was mentioning, trade union levels or trade union rates is one of the pillars that we look at. And so I think it's very important. And on the just transition work that we're doing, that methodology that we're trying to build to bring together the climate and the social, we've been actually reaching out to a lot of European trade unions. So this is how I first got in touch with Marco. We've talked to the CFDT in France. We've talked to the TUEC as well, to get their inputs, to get their views, to better understand what the just transition means from a worker's perspective, and what us as asset managers we should be looking for. So we definitely recognize the very important role of trade unions. Then the question is, how do you integrate that again in your investment frameworks? What are the KPIs that you should look for, and so on and so forth? And are there differences between, say, the Anglo-Saxon world, the continental Europe, maybe Asia, Latin America, and so on and so forth? And how do you account for those differences? So those are some of the challenges that we need to account for. And maybe one last word on the word defensive. So I do subscribe to the very good remark made by the participant, and it definitely it sounds negative. Again, I go back to the first thing that I was saying. I think social investment needs to be a long-term bet, and I think one of the challenges as a responsible asset manager, or at least that's what we aim for at Amundi, is to be able to convince our clients that they have an interest, a long-term interest in including those characteristics, not only in the short term.
Thank you, Mr. Puget-Abadi, Mr. Cravero, and Mr. Morello. What I get from this session is, it is necessary to develop legal frameworks that encourage investors to engage with companies to steer them towards sustainability patterns. Investors must engage with businesses to drive them towards a sustainability pattern. Business governance must be open to shareholder activism and worker participation. Acceptance of national, European, and international rules and frameworks, such as the SDGs, the OECD standards, and the ILO rules, is a crucial step in developing a sound methodology for sustainable investments. Social dialogue can achieve a great deal, especially when it comes to creating consensus on the notion of fair transition, including the definition of tangible indicators in support of new patterns for sustainable investments.